everyone, welcome to Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX Verify. Today we're going to assess the stock market's overall valuation by looking at 4 indicators that I update monthly. Let's start by quickly breaking down each of these methods. First, the Crestmont PE ratio adjusts for business cycles by looking at the relationship between earnings and GDP. At the end of November, the Crestmont PE ratio is at 43.8. Next, we have the PE10 ratio, which is calculated by taking the price of the stock market and dividing it by the 10-year inflation-adjusted average earnings. At the end of November, the PE10 ratio was at 38.9. Then we have the Q ratio, which compares the total market value to the replacement cost of all its company's assets. At the end of November, the Q ratio was at 1.92. And finally, the S&P 500 regression trend line. It examines the index relative to its historical growth trend using an inflation-adjusted trend line of the monthly average of daily closes. At the end of November, the inflation-adjusted S&P Composite Index was 193% above its long-term trend. Despite different methodologies, they all share a similar purpose. They help us gauge whether the market is over, under, or fairly valued compared to historical norms. By looking at multiple indicators, we get a broader, less volatile perspective than if we just relied on a single one. Now, to simplify comparisons, I've adjusted the 2 PE ratios and the Q ratio to their arithmetic means, and the inflation-adjusted S&P Composite to its exponential regression. On the vertical axis, you can see how much each metric deviates from its mean. So the big question is the stock market still overvalued? Well, looking at this chart, the answer is an obvious yes. But the real question is, by how much? To answer that, take a look at the table in the upper left-hand corner, where we can see how far each indicator is from its respective mean. In November, the Crestmont PE ratio was 177% above. The PE10 ratio was 119% above. Q ratio, 128% above. And like I said earlier, the inflation-adjusted S&P Composite is 197% above its regression trend line. So that puts the market's overvaluation somewhere in the range of 119 and 197%, depending on the indicator. This is one of the highest overvaluation ranges in history. Now, let's take the average of these 4 indicators and plot it, along with standard deviations above and below its mean. Think of the standard deviation as a measure of how spread out the data is. One standard deviation above or below the mean represents what's considered the normal range. When we move 2 standard deviations away, we're starting to look at outliers. If we move even further, like 3 standard deviations, now we're looking at significant outliers, values that really stand out. At the end of November, the average stood at 155%, the second highest level in history, behind only October's level of 157%. The average is currently over 3 standard deviations above its historical mean. Now I want to provide an alternative view. Let's adjust the Crestmont PE, the PE10, and the Q ratio to the geometric means, rather than their arithmetic means that we used in the first 2 charts. The arithmetic mean is like a simple average. You add up all the numbers and divide. But the geometric mean is more appropriate for things that grow multiplicatively because it smooths out the peaks and valleys more effectively. And this method is less sensitive to extreme values. With this approach, the overvaluation range shifts higher, now between 141% and 208%, depending on the indicator. Again, plotting the average of standard deviations, we see the latest figure at 175% is also over 3 standard deviations above its historical mean. So let's go back to the initial question. Is the market still overvalued? Each of our charts have led to the same conclusion. The market is significantly overvalued, currently sitting at one of the highest levels on record. Now, as we can see in these charts, overvaluation and undervaluation can last for many years. Therefore, these indicators are not meant to serve as short-term market timing tools. Instead, they're more appropriate for formulating expectations for long-term market performance. That's all for our November 2025 market valuation update. Thank you for tuning in. For more economic and market insights, you can find my content on the Advisor Perspectives website under the AP Chart section.